seconds. Three, two, one.
Whoa.
Rock and roll.
All right.
And I actually switched it on time that time.
It doesn't happen very often. You're getting pretty good at that
Does
keyboard,
not.
bro.
I got to be ambidextrous. Can't even spell it.
Very cool.
What do you got?
I was
What do you
going to
got
ask
for
you,
us?
what do you got for us
I
today?
got nothing, man. I got a cup of coffee and I hope that you got a slide deck.
Yep, I got a slide deck. I got a coffee as well. Okay. This is going to be a special edition.
This is where I need a
basically.
graphic to go special edition.
Special edition. Woo-hoo.
One of these days when I get time, I'll add all kinds of fancy stuff to this.
So, as you know, people have been asking, right?
Yeah.
Elliott Wave, what is that? Elliott Wave, because
We use it a lot.
We use it a lot.
I
It's the
should have brought
patents
my
for the chart.
book. I got the Elliott Wave book. I bought it.
Do you have it?
Yeah, I mean, I know there's multiple books on the Elliott Wave, but I bought the one that's like the
Elliott Wave
old-
Principle.
Yeah.
Yeah, because, well, that's the first link on the next chart.
Makes my brain hurt.
Oh, dude, makes me all excited.
Yeah, I know. It is actually. It is actually very.
I've read that book 50 times at least.
Yeah, you'd have to.
Yeah.
Like it's not something you could just read, just breeze through.
No.
Yeah, it's not Ready Player One.
No.
Or something.
Some of the charts in here are I took out of that
Cool.
out of that book, but yeah. So that and the technical indicators, like everybody's asking, MACD, RSI, slow stochastic, and there's a ton of technical indicators, but we're going to talk about those three, and so basically we're going to talk about the indicators and talk about Elliott Wave, and look at how to apply them in real life, both Elliott Wave and the technical indicators.
Awesome.
So, all right. So, weekly update show, 17 January 2021. I have never seen a market unfold in other than an Elliott Wave pattern. So, of course, Robert Prechter would say that. Robert Prechter is an American author and stock market analyst, best known for his financial forecasting using the Elliott Wave principle. I'm not going to read all this, but he's written a good handful of books. I have them, and I have all those books. Conquer the Crash was the most recent New York Times bestseller. The Elliott Wave Theorist is a newsletter that he's been writing, applying Elliott Wave to all kinds of different markets since 1979. He served on the board of the CMT Association, which is Chartered Market Technician, which is kind of the board that oversees technical analysis, and he was the president from 90 to 91 of that board. He also kind of founded this new sort of area of study called socionomics, and it's a theory about human social behavior leads the market leads social behavior. It's not the other way around. Socioeconomics is really cool. If you ever have any interest in that stuff, it's pretty fascinating, and it takes a minute. It's not intuitive. It's actually the reverse of intuitive. So his idea is it goes along the lines of like there's a thing on Wall Street that's called the skirt length. The shorter women's skirts get, the closer you are to the top of the stock market. And there's some goofy things like when horror movies are the genre of the time or whatever, you're at the bottom of a stock market.
Wow.
It's interesting. It's socionomic kind of theory. At any rate, he was the founder of, and he's not the guy that created Elliott Wave patterns, but that was created back in 18 somethings. But he's definitely the modern guy for it. Okay, so because you asked, Elliott Waves, that the first line there is the link to, you just go to elliottwave.com. That is actually the link to the Elliott Wave Principle, which is the book that we were just talking about. Great book. Fractals. We're going to look at that a little bit. Fractals are patterns within patterns. And the way that's the whole way this Elliott Wave thing works. So we'll talk about that and then do examples of applying Elliott Wave. Then we're going to basically do the same thing with technical indicators. RSI, MACD, slow stochastic, and then examples of how to apply them. Okay. This is one complete Elliott Wave cycle pattern. Okay. So you could say that this is one complete pattern, because you got 1, 2, 3, 4, 5, and then ABC correction, right?
Because that's generally what we're looking for, are those two combinations. They keep repeating.
Yes.
And then it makes larger 1, 2, 3, 4, 5s.
Yes.
And larger ABCs.
Yep.
Right?
Patterns within patterns.
That's
yep.
it.
That's it. So
you don't have to see this whole thing that we're looking at right now. In general, like, what you need to be able to see is the 1, 2, 3, 4, 5, and the ABC.
Yes.
And then build on that.
Yes. So fractals is patterns within patterns, right? So when you see, like we always talk about it, we're gonna show it here when we get to the examples. 2009 was the last real major low that we had. Since then, in a long-term, time frame, the chart we're going to look at is 15-year monthly. In that chart, you can see from the bottom in 2009, we've run this thing out 5 legs, right? So if we've run it out 5 legs, the next major move is going to be the ABC down, right? So, but within the 5 legs, because you can't really trade on a 15-year monthly chart, so it's right. So within there, so it's the same as this. If this point right here is the bottom in 2009, then on a 15-year monthly chart, we're like, I don't know, somewhere in there. But when you zoom it in and you look at the low from the most recent low, I guess the end of October maybe it is, then we're somewhere like here. So it's patterns within patterns. You'll see it when we get to it. But overall, this is ideally how it looks. And here's just a couple of things to point out, and then we're going to get to the actual rules. But here's a couple things to point out. The two leg usually pulls back 60% from the one leg, right? From the high of the one. So the one goes up, the 2 pulls back usually around 60%. The 3 from the 4 is actually usually more horizontal of a consolidation. So that's why I think the other day we were talking about Tesla, and one of my friends called and said, "Hey, should I sell Tesla?" And I looked at the chart and I'm like, "No way," because I could see clearly the 1, the 2, the 3, the 4 was a horizontal, and I'm looking at it and I'm like, "Nope, it's going to be over 500 by the end of the year," because it was clear in the chart. Because we needed to have the step for it to complete. And I'm like, nah, it's going to be over 500 by the end of the year. Well, it was over 500 by the end of the week, and now it's like 800.
Yeah.
Now, the next big move for Tesla is going to be this one, right?
Why didn't you tell me all this when it was $38?
Why didn't I buy it when it was $350?
We're too busy doing this.
Yeah, seriously. So if you just look at this for a little bit, you start to get you can kind of start to get your mind around it. The other thing, let's see, we'll get to the rules one in a minute, but 1, 3, 5. Usually 1 leg and 5 leg tend to be the same length. Not always, but they tend to be. And 3 tends to be the longest. And you can have extensions, which we're not going to get into. That gets more advanced. But as you can imagine, depending on the time frame you're looking at, if you're just looking at like this 3 leg right here, right? That 3 leg can look like, because you get 2 at 2, then you could have 1, 2, 3, 4, 5, gives you that 3. So then you could count 1, 2, 3, 4, 5, and this is the 2. So it's all patterns within patterns.
Before we get to, so I know there's probably a few people like myself early on in this that probably just went,
yeah,
right?
Yeah.
But I just want to take a second to point out before we go any further that if you trust us and you learn just the basic principles of this. Now we're gonna slide through this. I have definitely bought into. So for a while I was an not an intelligence analyst. I was an intel officer, but they teach us all about analysis, and I really bought into this whole patterns and patterns within patterns and trends and the data analytics. And this really does work. And the example that Jerry uses with the Tesla chart is a perfect example of how literally once you kind of know the fundamentals, you can look at a chart within 30 seconds and go, no, I'm not selling this, or no, I should probably jump into this. It is that simple once you kind of wrap your mind around it. So bear with us as we go through kind of like the micro, as we're looking at it, but it does work. So let's jump in there.
Works. Yep. Okay. So that's what a completed cycle looks like. And again, fractals just means this is a completed pattern, right? Because you got 1, 2, 3, 4, 5, ABC for 2. The whole thing is a completed pattern because you got 1, 2, 3, 4, 5, 1, 2, 3 for 2. So it's patterns within patterns. Okay. So the rules. This is the most basic, theoretically perfect Elliott wave. Okay, so here's the rules. Whatever the one leg, here's 1. So the one leg is going to go up, in price, however far it goes. The 2 leg goes A, B, C for 2, right? The 2 leg is 0.618 times the length of the 1 leg. So like I was saying before, it retraces 60%. That's what that is. This retracement here theoretically is 0.618 times the length of wave 1. Okay. From wave 2 to 3. So once you get down to 2, you're trying to figure out how long this one is. It's 1.618 times the length of 1. So 3 is whatever 1 was times 1.618. Okay, it's Fibonacci numbers. We're not going to talk about Fibonacci on this one. We've talked about him before, and we will again. But
that's just what it is.
That's what it is. Yeah, that's how the math works.
They came up with the math that way. So the idea being, if I know I just saw 1, I can estimate the 2 leg by taking the 1 and multiplying it by, I just forgot the number, 1.68.
Yeah, 1.618. Yeah. So 1.618, and the reverse of it is it's the golden ratio. I mean, you can Google it. There's all kinds of stuff you do with Fibonacci.
But the takeaway is that I can guesstimate the 2 leg, even though I'm not there yet, which is helpful to know that, like, well, we know it's going to be at least this, or should be, right? So that's where that comes in handy.
Yeah, definitely. I mean, you can look at long-term charts and apply these rules and say this is where you expect the number to be. That's your sort of your plan A. And then you watch it as it progresses along there, and if it goes against you, great, you can make adjustments.
Right.
But it's the
gives you some guidelines,
basically.
Right. Yeah. Some left and right limits.
Yeah. So 4 is 0.382 of 3. So what does that mean? Wave 2, right? You multiplied it by 0.618. So you had more of a decline in wave 2 versus 1 than wave 4 versus 3. Okay? So what I'm saying is wave 4 tends to be flatter. You have less of a decline in wave 4 than you have in wave 2. And then wave 5 tends to be the same as wave 1. Okay? This is a really good chart because it incorporates most of the rules. There are a couple other rules. Wave 4 can't be lower than the top of wave 1. Okay, there's some other goofy rules in there like that, but for the most part, this chart gives you all the basics.
And by and large, this holds up. Like it happens.
Yeah, it happens.
Which is crazy to think about, that the market actually follows this. and very rarely ever wavers.
Yeah, well, like Pector said on the quote, right? I've never seen a market that doesn't evolve in an Elliott Wave pattern.
Yeah, you just got to be able to see it.
Yeah, you got to be able to see it. So famously, Pector thought that the top in 1987 was the top of the top of the top ever. He thought like after 87, he thought the crash in 87 was going to be the beginning of a giant move down, and it wasn't. And he actually held on to that like belief and didn't get out of that position for a long time, and it kind of hurt his reputation for a little bit in there. He was. I mean, my dad. This is not me telling the story. This is my dad telling the story. So, okay.
This is what you guys talk about at the dinner table.
Yeah, right. My dad used to follow Pector like religiously, and he made a bunch of money doing this stuff. And once you think you're good at it, and you think you can look at the chart of Tesla and go, "Oh yeah, it's definitely going to 5," it'll go against you. Once you think you know what you're doing, right? So you gotta know what you're doing, and you also gotta know that it can go against you just as easily because
they are indicators. They're not the be all and end all forever everything, right? Like that's not the only thing.
It's not the only thing. The thing about Elliott patterns is that you can't identify. It's in hindsight.
Right.
Okay. So you don't know for sure that was the pattern until the pattern's complete.
Right.
So the way if you go to elliottwave.com, they do a primary count, a secondary count, and a tertiary count. Yeah. Right. If this,
yeah.
And as long as it stays within that left and right limit, then we're in our primary count. Yeah. If it breaks that, now we've gone. The rules have been broken, so now we're going to Plan B. It's a whole lot better than hoping.
Well, I was going to say like that's an awesome option, right? Is to say that basically we've whittled it down to basically 3 options. That's better than 73 options,
sure.
Right? Which is, infinite amount of options is probably a better way to put it. So this gives us guidelines. So
yeah. So here's a way that kind of works, right? If you're we're looking at the same chart. We think we've identified a low, a bottom right here, let's say. And so because we had, 1, 2, 3, 4, 5 down to the bottom. And so now we're expecting a 5-leg recovery. So we've identified this as the bottom. If it goes 1, A, B, C, 2, and then it comes up here and stops. If 1 is the same as what you expect it to be 3, and then it rolls over, the pattern changed, right? It's not the same. So what that ends up being is this is actually a 2. Right? A, B, C, 2. So your next step is going to be down. So you were wrong about this initially.
Right. It still played out in the pattern. It just
not the one that you
exactly.
thought it was going to be.
Right,
yeah.
right.
So that's why he says I've never seen a market that doesn't unfold in an Elliott Wave pattern. It's just that I might not have gotten it the first time. Right?
Might not have seen it.
Yeah.
Because you got to wait for it to happen to confirm it.
Yes. So how does it play out in real life? Okay. We talked about how 2009 was the last major low. So here's 2009. This is I usually we use candlestick charts, but I just use a line chart here because it takes away all the noise and it's much easier to read. So it's pretty easy to see this one. It's pretty easy to see on the one hand. On the other hand, I'm going to go through two options here. 1, this 2 could be, it could be here or it could be here. But let's just say that this consolidation, this correction here is 2. Okay? So we got 1, 2, 3, 4, and we're in the 5-leg right now. We're in the 5th of this fractal of the pattern, right? This fractal. So depending on how you look at this, you can say, like we just did, 1, 2, 3, 4, and this is going to be 5. The other way you can look at it is you can say, this is 1, 2. And then within the 3 leg, you got 1, 2, 3, 4, 5, which gives you 3, and then the 4, and then the 5. So there's not only one way to count it. Okay, but when you step back and you're looking at the big picture of this, it's pretty clear. However you want to, however you want to work the 2, we're in the 1, 2, 3, 4, 5. And I actually talked to my coach because I had a big question about this. So as we all remember, in 3 weeks, the market lost 35%. And 3 weeks isn't enough time to correct this huge move. It's not enough time. That was my problem. It wasn't the amount of the price, because the 4 leg came down. Because if this is the 3, this would have been the 4 of the 3. It's getting complicated. The fact that this dot is a little bit above this dot, but pretty close to it, means that this is definitely an important. It's either a 2 or a 4, and it had to be a 4. But ordinarily, it would take longer than 3 weeks. So that was my question to him, and his count is a little bit different than mine. But at the end of the day, it's the same thing. We get to the same place, which is this piece. There's no doubt that this, which is my plan A, is calling for prices to go higher going forward. So 2 things out of this chart, right? We got prices that are going higher going forward. But once we get to that 5, we should have an ABC that comes down here. So the 2 is somewhere in the neighborhood of this 4. Right? So that's going to be a big move back down.
And so as we get closer and closer and closer to the top of the 5,
Yep.
Right, or to the 5,
right,
that's when it starts to get riskier and riskier and riskier, right?
Yes, definitely.
Right. So as that, I just like to throw that in because that's our position, is minimizing risk. So if you're following along with this, just know that as that line gets longer, it starts to get riskier because it's going to come down. It's going to.
Absolutely, definitely. So we look at this chart, and this is the chart that I put up a million times over the last couple of years, because it's the
a million.
Well, a whole bunch, because we know that's a low, and it's playing out in this really good 5 leg pattern. So it's 15 years monthly. That's great. How does it apply to us today? This is one fractal, right? 1, 2, 3, 4, 5. What we really want to know about is what's going to happen right there. So here's that. This was the top. This was the 3 from the last chart. This was the 4 from the last chart. And now we're playing out the 5. Okay? And the 5.
So we're drilling in to look at a Elliott Wave pattern in an 18-month spread instead of 15 years.
That's right. So now it's 18 months daily instead of 15 years monthly. So we've drilled into the 5 of the bigger pattern. So it's fractal, right? Inside that, the smaller the time frame, the sort of the more I don't want to say risky, that's a bad word, but the shorter the time frame, the more you got to kind of pay attention.
Well, the more difficult it is to read because you don't have as much data, so you're looking at a much smaller time frame.
Yeah, it's basically you get lost in the forest for the trees kind of thing, and but that's just the way it goes. Because you have to get down to a place where you can make reallocation decisions, and you have to do that on a daily chart. You can't do it on a monthly chart. That's really the bottom line. I mean, you can. It's just that you'd have to accept a whole lot of volatility in your account to do that. So no matter what, that 35% drawdown here in March was a significant move down, and it definitely established a bottom. Okay? So the bottom that we're working with now is 4. So the next, we should expect a 5 legs higher, right? So we get 1, 2, 3, A, B, C's 4, 5. We got that, right? And so when I saw that a couple months ago, the only rule for a 5 leg is that it has to exceed the 3. So that 5 did get a little bit above the prior fractal's 3, right? Because if this ended up being the 5, right? So this is 3, this is 4, and this is 5. If that's what ended up happening, then we would have gotten this. Okay? We didn't get that. We got this. That was a 2-month pretty decent correction. It was horizontal because we said the two leg usually does more something like that, right? So I would have expected it to go a little bit lower, but it didn't. But we have 1, 2, 3, 4, 5. So either it's 5 relative to this 3, or it's 5 relative to itself, which makes it a 1. Okay? So as I'm looking at this, once I saw this 2-month correction, that means this 1, or this high is not a 5 leg, it's a 1 of a longer pattern that's going to extend. So that's why we were talking about last week my sort of bullish bias right now, and it's coming from this 2 leg. So my plan A is that 1, 2, 3, right? 4, 5. So, this is June on this chart, so we're back here somewhere at the end of 21, right? This 5 is what I'm talking about here, is this 5.
Nice.
Does that make sense?
Yeah.
Okay.
Well, to me it does. Hopefully to everybody else.
Yeah. Yeah.
But I watch you do this all the time.
Yeah.
Yeah. I just find it fascinating because you're able to do that, right? And so this indicator matched up with many of the other ones that we're going to look at, start to build a picture where you can feel confident.
Yes. Yeah. So, yeah, like we said the other day, you add that to the 10-day moving average, like last Monday when the market, we had a big engulfing negative day and then it reversed a little bit and still closed below the 10-day moving average, and people are like, why aren't we getting out? We're not getting out because we're not far enough extended from this 2 leg. The price has to move higher based on the Elliott Wave count. And to be honest, no matter which count you look at, so we said plan A is the one I just drew out, right? Plan B is probably this. This is 1. This is 2. This is 3. If this leg and this leg are the same length and it rolls over, that's it. So the 5th leg of the overall pattern doesn't have to extend out in 5 legs. So I'm really watching here at this point when this length is the same as this length, because it could be 1, A, B, C, 2, 3, which would give us an overall A, B, C, which means it's a correction. Yeah. And then we're coming down.
Yeah.
So,
but that makes it easy enough to watch.
Yeah, definitely.
Because one of those 2 things are going to happen.
Yeah.
And you kind of know when it might.
Yeah, the timing.
That's always the hard part.
It's the tough part. Yeah.
That's why you got to be looking at this daily.
Yeah. Yeah, you do. So we're going to get, say the price comes out, and it's eventually going to be the same length as 1, right? 1, 2, and we get here to 3. We got our trend lines, moving average lines, whatever. If it breaks below that, that's when we're really thinking about, okay, maybe we're wrong. Maybe we have to switch to plan B. So we'll see. But right now, it looks like we're in good shape. This is the next sort of near-term target there, is 3. That is it for Elliott Wave. What do you think?
I think it's awesome. I think it's not it. We could probably talk another hour, but
we're just talking about the same thing. This is the overview. Yeah. All right. Technical indicators. So this stuff gets really over everybody's head. It's what we're trying to do here is overlay indicators that we can use to validate the price within the Elliott Wave pattern. So RSI is a momentum indicator. Okay, it's I mean, physics from high school, momentum, right? Things, if your car is going, your car went from 0 to 60. It takes some amount of time to get there. And as you put the brakes on, it's still going forward. It takes some amount of reversing to make the car stop, right? It continues to go forward even as you're braking. It's slowing down forward progress, right? But it doesn't happen on a dime. So if it's the same kind of idea, the market is moving higher. It doesn't reverse. You can see in the volume and in the technical indicators as the internal things are changing that ultimately show up in the price. So that's why we're using technical indicators. So the actual thing of how it works, this is the idea, and it was developed by Wells Wilder, and most of the stuff has been around for a relatively long time. But the traditional interpretation, right? So when RSI values is above 70, the idea is that the security is overbought. It doesn't mean that it can't stay overbought for a long time as price continues to go higher. What you're looking at is when it crosses the lines. So we're going to get to that when we look at the examples. So relative strength is a momentum indicator. Okay. MACD is a different type of momentum indicator that tells you kind of different information. You're using two different moving average lines, and when moving averages use different dates that they expand the price over. So when one crosses the other, it identifies a change in the momentum, and they call it the signal line. So you get the exponential moving average, and then the MACD, the signal line, and then you have the trigger. So if usually it's the black line crosses the red line on the way down, it's time to sell. Black line crosses the red line on the way up, it's time to buy. And you get the histogram in the middle, and we'll show that on the chart. And by the way, the link's all at the bottom. Investopedia is a great resource. So we have the links on the charts here, but you can just Google it or just go to Investopedia and put in technical indicators, and it'll give you a giant list, and then you click on those links and you can read about any of the technical indicators that you want. Stockcharts.com also has a school in the site that's really, really good. Stochastics are an oscillator. You could use slow stochastic, fast stochastic. It's all based on over what time range you want to look at it, and so it depends on whether you're like day trading or trading on a daily chart or a weekly chart or whatever. You can adjust the oscillators that help confirm the price over the time that you're looking at. So stochastic oscillator, it is one of the more popular ones. It'll identify an overbought and oversold, and it's also again a momentum indicator. Okay. So what do they look like in real life, and what's the value? Because the math, I didn't even post the math. The math just gets to be ridiculous. But here's what it looks like in real life. This is what we want to see happen. So this is the S&P. What is this? 1 year daily. So back in here, when we had the top in February, so I drew these dotted lines that just starts at the price, goes down through RSI, through the MACD, and through the slow stochastic. So you can see that the price was at a high. The RSI had already come down because there was the high of the RSI. So the RSI was a leading indicator in this case. The MACD had also, it had been flat for a while. So once it went negative, that was a pretty good indicator. And the slow stochastic hadn't quite gone hadn't gone negative yet because that was actually right here. So the slow stochastic was a lagging indicator at that point. The RSI was leading. But once the drop actually started happening, which was, say, right here, all of them went negative. You can see they all kind of go negative at the same time. So if you draw these lines that connects the highs or the lows with the indicators, you can kind of get a sense for how when they turn is really important, and which one is leading and which one is lagging. So if we look at the bottom, right, because everybody wants to get back in at the bottom. So that was the bottom in March. The bottom of the RSI was back here. So it went along that 30 line for a while and never got below it again. But then when it popped really above it, MACD had crossed and slow stochastic had crossed. So it's not 100%, but it's a pretty good indicator that that's a good time to get back in. So when I say it's not 100%, I didn't draw all these lines, right? So, for example, let's see. The MACD went negative there. You can't see it very well, but on one of those days, the black line crossed down through the red line. And you had the stochastic turning over. And yeah, the price did break down a little bit there. But you got to give it a little bit of room.
Got to let it play out.
You got to let it play out. I mean, it's easy to in hindsight draw these lines on a day-to-day basis to make ongoing reallocation decisions. It's difficult, but the more you kind of look at the overlays of the price chart with the technical indicators, you just, like Conan said, you just start to see it. So if you go forward to, let's see, actually here's another kind of important piece. This was a 35% price move down, right? And we had RSI bottom out, MACD bottom out down here, slow stochastic below 20 down here. So you could say, yeah, great, that's definitely a bottom, and we had a huge price move. Back here, we talked about that as being our 2, right? We had RSI never got down to 30. But we got slow stochastic over here, below 20 and below 20 over here. So eventually we had MACD down here, negative and negative here. But the price move wasn't anywhere near as drastic as it was back in March. So all I'm saying is the best way to look at this is on the slow stochastic. You're below 20 here, and you're below 20 here. But you have a minimal price move here, and you get a huge price move here, right? So you have to be able to look at the patterns. So what that tells me is when slow stochastic gets down here below 20, right? Even though the price hasn't moved very much, I'm expecting that to be the bottom, right? You're not always going to get these big moves in price, is what I'm saying. All right. That's what it looked like on the C fund. On the S, it's the same kind of idea, right? We're at a high. RSI was at a high. MACD was rolling over, and once it did, right, the histogram is the blue here in the middle. So when the blue is below the 0 line, momentum is decreasing. You got slow stochastic there at the top. Same kind of thing as the C fund. But here's an example kind of what I was talking about before. We had a high here on the S fund, right? We had a top there in the RSI. All these are at a top. And yet we had a little bit of a dip, but definitely prices were going higher. So you didn't want to get knocked out of there. If you were looking, if you didn't see forward, you might look at these indicators and say, you know what, I'm getting out because we have a high, right? I'm getting out. And you could also actually, here's another good example. 1, 2, 3, ABC is 4, 5. Okay, so if you didn't see all this, so pretend you can't see all that. You're looking day to day. You've just done 1, 2, 3, 4, 5. Then you would expect the next move in terms of Elliott Wave to be ABC, right? We actually got that. It was ABC. It didn't overextend on the downside, but we got it. Okay, but you could definitely at this point with these indicators, you could have thought we were at a serious top, and it didn't turn out to be a serious top. So your plan A might have been once, especially with that gap down, you definitely could have thought the market was going lower. But once it went 1, 2, 3, this low was higher than that low, then you know it's going higher. And then especially once it got back above that high, that point there. I'm getting too complicated. Okay. So, yeah. All right. What does the iFund look like? Same idea. RSI had already rolled over. MACD just turned negative. Slow stochastic. We were at the top. Had to get out. Once we got to the slow stochastic below, had turned positive after being down at -20. Black line crossed the red line on the upside. RSI went positive. No reason not to get back in the market there. So where we are right now, this is kind of a pretty good one here. 1, 2, 3, 4, 5. Very similar to what we had in the S1 before. But this one is playing out in like a 1, 2, 3, right? And it kind of makes me nervous because it's not how a 2 should be. So in the big scheme of things, I'm really looking at the iFund when the length of this 3 right here gets to be the same length as this. I'm really looking at that closely because we could definitely get 1, 2, 3, and then the iFund comes back down because the 2 leg isn't how it should look. On the other hand, this is a huge sideways consolidation, and once we had that breakout, you have to get into the iFund. And that's what we did. It's bottomed out here on the stochastic. It turned positive here on the MACD, and it had already turned positive back here on the RSI. So, and coming off of, there's a whole bunch of pent-up demand in here is what this creates. So you had to get back in. It's just the question is now you're looking at both the shape of the pattern and the technical indicators and a whole bunch of other, it's all comes down to the way the pattern looks and the fractals. So that's how you use the combination of all of it, right? The technical indicators, Elliott wave count, the longer term trends, the shorter term trends, you put it all together and you sit down and you make your reallocation decisions.
That's it. And there are, just to point out, more technical indicators out there.
Oh, yeah.
We have members that like other ones better than other ones, right? There's more than one way to. There's definitely a lot of components to technical analysis, and it just comes down to, as I see it, it comes down to which ones are you most confident in, right? So some people feel more confidence in a particular indicator because they're just well read on it or they understand it.
Yep,
right?
Definitely.
And so I think the challenge is picking the ones you understand, And then, as you pointed out earlier, we all have to have a coach, right? We all have to have sort of a validator,
Yep.
right? And so our plan is to be a validator for many of the people that are members, right? And so, but we have validators, right?
Absolutely.
Because you just kind of have to continue to do that, because none of us are going to nail it 100%.
Right.
And so if you have these sort of, so learning these technical indicators gives you left and right limits. It gives you lines in the sand. You know, you can kind of,
Right. However you want to
describe it, whatever you can wrap your mind around and say, okay, I have confidence in these particular indicators. What I would caution against, and I look for you to chime in here, is don't put too much confidence in one, though.
Absolutely.
Right? So using what we talked about today as an example, you can't just use Elliott Wave, right?
Yep.
You can get a lot from that. But if you only use that, you're going to miss something.
For sure.
Yeah, you've got to use a combination of indicators, and as you guys see, if you follow along with us, that the ones we've chosen sort of kind of line up neatly, right? So it makes it easier. And as a technical analyst, whether you're new to it or have been doing it for 20 years, it really comes down to making yourself a little chart dashboard, right? And any of these websites that we use, stockcharts.com, bigcharts, koifin.com, whatever your flavor you want to use, making yourself a little dashboard that you can just take a peek at, right? Or our site, now that we have them on there, we're using Koifin to do it, but just take a quick look and go, okay, indicator. All right, I feel good.
Yeah. The once you get your mind around the Elliott Wave thing, you don't need to do it every time. You know where the left and right limits are.
You know where you're at.
Yeah, you know where you are in the pattern.
Or you're pretty sure where you're at. Yeah.
Right.
Because it hasn't happened yet, and you definitely know once it's happened.
Right.
But the point is at least you've got a guideline. You've got an azimuth.
Yes. Yeah, you know the direction you're going, generally speaking, right? And the technical indicators, particularly technical indicators and the moving average line. So the 10-day, for us, I use the 10-day because we only get 2 moves a month, and the 10-day is the best for me. It's the one that will keep me in the stock funds the most over that time frame. This is the hardest thing, to be honest, with the TSP. Is these having your trade in by noon is bad. Only having 2 trades a month is really bad. It makes it really hard. Those are the rules. There's nothing we can do about it. It just makes it hard, and that's why, for me, the 10-day moving average works. The 50 is too long, and anything shorter than the 10 is day trading, and you can't do. You'd be in and out too many times.
Right. But on that note, one of the things that we emphasize is that as you learn these principles, as you learn these fundamental sort of indicators, you can use this in any sort of investment.
Absolutely.
Portfolio, meaning your IRA, your 401k, TSP, obviously, but day trading. There are people that day trade. All they're really doing is zooming in on one day today, given day, and using these same principles, same indicators.
Yeah.
They're just zoomed in. Now it starts to get very difficult sometimes when you're zoomed in that much, because you've got to make sure you remember where you're at in the big picture, and that helps you trade. So with that said, if you learn these principles, you're able to apply them in a lot of different investment scenarios.
Yeah. If do you have is the chart still up, that one?
It is now.
Okay. So the iFund, right? If you were looking at this chart and it was one day, right? So let's say this is 9:30 in the morning, right? The market gaps up on the open right here, ran higher until 11, then went sideways until 2. And then at 2:30, it gapped up above this channel line. You could you'd throw a bunch of money in there and then sell it up here at 4 o'clock, and you just made a killing.
Right. Especially if you got out at the bottom there earlier in the day.
Right.
Jump back in.
Yeah.
Right. That's the point. We can't really do that, but it's the same thing. Yeah. It's the same thing if you had the ability to jump in and out. And you there's a lot of funds, a lot of investment products out there that have very low fees now.
Yeah, 0.
Right, 0.
Yeah.
So you could jump in and out and not have a lot of these fees. Anyway, the point is, these are very important fundamental principles to learn, if you're going to actively manage your investments and without having to rely on someone else and tells you that, you know, again, because most of the financial advisors that we know, most of the industry is on this sort of long-term plan. They lay out this thing, and they don't pay attention to what the market does day to day.
Right.
They just don't. They say, you know, ride it out. Well, you know, that's a way to do it.
Yep.
It's not our way. Our way is to actively manage it, but the understanding is that once you learn these, you don't really have to spend hours a day doing it.
No, right.
You know, Jerry does it for fun. Right,
but fun, but yeah.
I see you giggle sometimes
yeah,
when you see
I
a
giggle
chart.
sometimes, all right.
All right, was that what you got for us
I
today?
think that's it. I think
we had questions as always. If you have questions, put them in the comments section of the video, whether it's on Facebook or YouTube. Please share these with your friends.
Yep.
Make sure to check out, if you're a member of our website, if you're a subscriber, every week we put out a newsletter that has really in-depth analysis and charts and really gets down into the weeds of what we're looking at for the previous week, what we're looking at for the week to come. We always have this show available to the public that does its best to educate our viewers on technical analysis of the TSP.
Perfect.
Yeah. All right. Well, we're out. It's been a great week, folks, and hope you have a great week to come.
Cheers.
And cue music.
Dun.